Hello everybody, a very warm welcome to SD Capital's official YouTube channel. Today's session, we are going to explain the art of profit booking. How do you book profit? Ultimately, that is what we are all after. And we will try to give you some basic rules to follow. At the end of today's session, as usual, there will be a free stock recommendation. So please keep on listening for the free stock recommendation. But before that, today's topic. You would have heard on the market, on the street, that many people keep on telling you that this is the stock you go for. This is the stock which is going to be a multi-bagger. This is the stock which will give you a 50% return in a year. It has given that in past. And so on. I would like to re-emphasize one thing once again. That is, risk and return in the world of investment is always proportional. So if you take higher risk, the chance is you will get a higher return. But that also means your loss can be higher. Because risk is nothing but deviation from the expected return. So if you invest in a stock which may give you a 50% return in a single year, it may actually erode your capital by 50% in that same year. So you have to be very careful, very disciplined about choosing your stocks. You have to make sure that this is aligned with your risk appetite. If you are someone who needs a return more than what you normally get if you keep a fixed deposit with a bank, or if you go for a typical savings scheme, government savings scheme, you need a slightly higher return than that, and you are not ready to gamble with your money, please be careful while choosing your stocks. If you are someone who has a lot of money and you don't care losing it, then you can pick those high risk stocks. Today's session is actually for people who is careful about their money, at the same time who wants to book profit judiciously. So when I said like you have to choose the right stocks, one thing you will hear time and again, invest in blue chip stocks and just forget it. Over 10 years, 15 years, 20 years time, you will get an unimaginable return. The question is that blue chip stock, which is essentially say Nifty 50, investing in one of those stocks or two of those stocks, is that fail-safe mechanism? No, not really. There are many instances when, because of different reasons, companies have gone bust who were part of Nifty 50. If you look at the world market, you will find many such instances where companies were considered infallible and they have failed. World market, I can give you a very, I can give you an example right away. Kodak. Kodak was a household name across the globe. They have failed eventually because they couldn't cope up with the pace of innovation. They were still stuck in the world of paper photographs when everybody moved digital. Back at home, I can give you quite a few examples. In fact, today, I'm going to give you at least 4 or 5 examples where stocks were considered like infallible, blue chip, and they actually failed. So even if you invest in a blue chip stock, you have to take a view of that stock every now and then. That periodical review will help you understand where this stock is headed. If the company fails to innovate, if management takes a wrong decision, if there is a government policy which goes against their business model, if there are tax implications which is harming their revenue potential, if there are new competitors coming up who is offering better product or better price point, these companies are going to fail. For example, Reliance Infrastructure. I actually have the rates written here. So I am going to take a look time to time at this piece of paper and walk you through the figures. Reliance Infrastructure. 2008 stock price was rupees 2,600. Today, the stock price is at rupees 80, 96% decrease. And probably there is almost zero chance that it will bounce back to its previous level. The next one, Jet Airways. Again, a pretty much household name in India. In the aviation sector, one of the giants. 2005, it was trading at rupees 1300. Today, it is at rupees 100. So if somebody bought 10 stocks at rupees 1300, that 13,000 investment would have come down to 1,000 today. 93% decline. JP Associate, another big name. 2008, it was trading at rupees 300. Today, it is at rupees 12. The prime example of capital erosion. Videocon, everybody probably remembers that company. Shah Rukh Khan used to appear in the advertisement. It not only TV, they had many white goods like refrigerator, washing machine, many different appliances. They were trading at rupees 850 in 2008, and today they are at rupees 7.50. Rupees 7.50. These are all private companies. I know the next question coming to your mind is, what about government organization? They must be fail-safe. No, not true. Central Bank of India, a government organization. 2010, the stocks were trading at rupees 210, and today it is at rupees 25. So I can go on, but the point I'm trying to make, there is nothing like fail-safe. And investing in blue chip means peace of mind forever doesn't hold true. You have to be careful. You have to take a stock of the situation every 3 months, 6 months, 1 year, and see where your investment is, where the company is heading to, and make an exit plan accordingly. In our previous videos, we have explained the importance of stop loss. It is even the most expert on the street, they will make error in their judgment every now and then. If they pick up 10 stocks, one is probably going to go south. There is nothing like there is nobody who can predict that all 10 stocks they have chosen will go positive all the time. SD Capital free stock recommendations. Every video we provide free stock recommendation. We have in the previous session, just before this one, we have evaluated how our free stock recommendations actually work. Out of our 24 stock recommendations, one actually headed south. So we were wrong 1 in 24 times. Thereby, it is very important to maintain strict stop loss, and if you have to book loss, please book loss and exit, but do not waste your money. So coming back to the central bank example, in 2010, it was trading at rupees 210, and now it is 25, as I said. So say somebody bought the stock at 190, rupees 190. They couldn't exit at 210 or 220. And if that person is conscious, if that person is careful, they would have exited somewhere near maybe 200, 190, 180, 10 rupees loss per stock. But that would have saved them from today's situation where the stock price is rupees 25. So you have to maintain strict stop loss every time you invest. Apart from all other things we have discussed, proper diversification across the sector, proper diversification across single sector, you have to keep an eye on individual stocks performance and make sure that you are booking profit when you need to and you are exiting when the situation is not so great. With that, today I will explain our offerings, product offerings once more briefly. in the previous video, we have touched upon our offerings, and again, we are really getting flooded with questions. So 3 offerings we have: create wealth, invest in retirement, and maintain existing portfolio. Create wealth is a product where you don't pay any annual fee, 0 annual fee. It is only profit and loss sharing basis. You trade from your own account. Money lives in your account, not in our account. And you trade as per our advisory. And at the end of settlement period, when we settle at the end of our service, we do share your profit as well as loss. We are probably the only company who is doing so. And there is minimum upfront investment is rupees 10,000. Minimum tenure 2 years. The second offering, invest in retirement, that is to encourage you start saving early in your career towards retirement. Bank interest is falling fast and inflation is holding tight. So in view of that, the best possible option for anybody is to start investing towards their retirement early in career and take advantage of stock market investment. If you start to invest at the age of 55, you cannot invest in stock market because short-term investment in stock market is not advisable. So this is our second offering where you can start. For this one also, there is no annual fee. We share profit and loss both. And here also you can start with an upfront investment of rupees 10,000. Where Create Wealth is designed to deliver maximum possible return depending on your risk appetite and your investment pattern. Invest in retirement is basically to deliver the return you need while preserving your capital as much as possible. Manage your existing portfolio. This is where for a fixed fee, we actually take care of your existing investment. We will streamline your existing investment. Where you need to exit, where you need to hold on to stocks, we will advise all of those to maximize return for your existing investment. With that, now I come to our today's topic, and now I come to our free stock recommendation. I just completed talking about our topic today. So today's free stock recommendation is Colgate-Palmolive. SD Capital research team has got reasons to believe that Colgate-Palmolive has a bull run ahead of it. If this works for your portfolio, please start building your position into this stock. As usual, we will share our stop loss, our target price with our customers for this stock. But you have seen how our free stock recommendations work. So if you are interested, please start building your position in this stock. That's all for today. Thank you. Take care. We will meet you again in the next session. Bye.